So now we'll look at the stockholders' equity section of the balance sheet. It's important to distinguish this from the actual statement of stockholders' equity, which is different. Okay, so you have your assets listed, your liabilities, and then this is just your detailed stockholders' equity section. So I think on the notes I break it down into kind of an outline form of it, and then if you have that outline in your mind, it's easier to, you'll get everything in the right spot, and then you can fill in the details. So your main sections of it are going to be your paid-in capital. Okay, so paid-in capital, that's your first main section, and it's composed of the capital stock, where you describe all your stock, and then the additional paid-in capital. So you got two parts of paid-in capital. The second section is going to be your retained earnings, okay, and then you've got your total paid-in capital and retained earnings. And then after that come what would be your comprehensive income, or you take off the treasury stock, and then you've got your other comprehensive income items down below. All right, so let's look at this a little bit in more detail. So for the first section, the paid-in capital, that's the invested capital in the company, as opposed to the earned capital, which is, if you've got the net income, less any dividends that haven't been paid out is what earnings you've retained. So this is basically your earned capital of the company. This is the money or the resources that people have invested in the company. So capital stock, you're going to list your preferred stock first, and followed by your common stock. So let's look at the preferred stock. You do the preferred, the common, and then if there are any stock dividends distributable, that's stock dividends, not cash dividends, any stock dividends, those get reported right in this section because they will very soon turn into more common stock. So you do your preferred stock first, and you have to tell the whole story of it. You have to say what the dividend rate is. It's 6% preferred. You have to say what the par value is. You can tell a few things like, is it cumulative? And then you have to do the number of shares authorized, issued, and outstanding. So there's 10,000 authorized. That's how many shares the company could issue. It's stated right in the Articles of Incorporation. Of those 10,000, 4,000 shares the company has issued onto the open market, and apparently they're all still outstanding. Okay, so that totals 400,000. To get that 400,000, you've got the 4,000 shares times the par value, and that's what gets reported as your preferred stock. Okay, then you come down to your common stock. You have to say whether it's $10 par or stated value it could be. Here we've got 100,000 shares were authorized, 20,000 shares they issued, but only 19 shares are outstanding. Well, where are the other shares? There's 1,000 shares missing. We'll run into them over here because 1,000 shares have been bought back as treasury stock. So authorized is the number of shares they could issue according to the Articles of Incorporation. 20,000 is the number of shares they've actually issued, and they bought back 1,000, so there's 19,000 left outstanding. But you'll notice here that the common stock, the valuation represents the 20,000 shares times the $10 par. That's the 200,000 shares. And then the treasury stock that's been bought back will get deducted towards the end. Okay, and then here's our common stock dividend distributable for 10,000. So we end up with the total capital stock. Separated out is the additional paid-in capital over and above the par or stated value. So you do the preferred first. It's in excess of par on the preferred is 80,000. In excess of par or stated value on the common is here. And then it's simply on treasury stock. So if you remember the treasury stock transactions, we would have additional paid-in capital on them. And so this is simply on treasury stock because once the stock is bought back, it doesn't have the par or stated value. It's just treasury stock, and it's on the books at its cost, which we note. Okay? All right, so what else do we need to know here? Okay, if you want to figure out, how much the stock was issued for, say you do the preferred stock, you have 400,000, which is the par value times the number of shares issued, plus you've got the in excess of par on the preferred, so they issued 4,000 shares and they got 480,000 altogether. So if you divide that out, the stock was issued at 120,000 a share. And you can do the same thing for the common stock to see how that works. Okay, so let's take a look at the rest of this here. We've got our total of our stock, our total capital stock, our total paid-in capital. Okay, I'm sorry. We've got our total of the capital stock. This here is the total of the additional paid-in capital, and you can do a separate line for that if you want to. I just was obviously out of room here, so this is your total additional paid-in capital. Here's your total capital stock, and so here's your total paid-in capital, your total invested capital altogether. Okay, so that's 830. Then we go up here, and we've got the retained earnings, which is just usually one number. And then we do a total, and you wouldn't abbreviate on the statement, I'm just obviously out of room. So total paid-in capital and retained earnings. And then at this point, we go less any treasury stock that's been bought back. So that's a deduction to our stockholders' equity section. And then there would be other, what you'd call the comprehensive income items. And that the one that we know about are the unrealized gains and losses on available for sale debt investments. And so that's the one I chose to use here. So we've got an unrealized gain. And so then once we take our paid-in capital and retained earnings, we add and deduct the treasury stock, add or subtract any unrealized gains or losses on available for sale debt securities. And then we end up with our total stockholders' equity. Finally, other items that could be reported here we have not covered, but you might run into in later courses. These would be deferred gains and losses on derivatives, gains and losses on foreign currency translation, and some net unrealized gains or losses on pensions. So there's a few other things, but those would be the main ones. But this, mercifully, is the only one we've run into so far. So you do your whole stockholders' equity section, and you do have to do out a few of these, and they actually start to make sense. But I keep the overall framework in mind you do the paid-in capital, which is your capital stock, and your additional paid-in capital. Do the appropriate totals there. Make sure you do the preferred before the common, in each section. You get your retained earnings, and then you do your totals, and then you take off any treasury stock, and then your unrealized gains and losses on the available for sale. The only other thing would be the notes and the disclosures. The disclosures in the notes to the financial statements. And I'll let you read over them, but you basically have to disclose anything that would be pertinent to users of the financial statement. So you'd have to talk about the rights and privileges of each stock. And really the best way to get a sense of these is to just go and pull up the financial statements of your favorite company if you have one, and just sort of read their notes on to the financial statements to sort of see where they end up. We don't get into too much of that at this point, but you should be aware that there are extensive notes that go along with all this.